How can average working citizens like us, how can we reform our unjust financial system to erode the wealth and power of big banks, traditional corporations, and the super rich, and redistribute that wealth and power to average working citizens without relying on politicians or regulations? This is the question we ask on the Crowd Effect podcast. I am your host, Paul Lovejoy, activist investment advisor and founder of Stakeholder Enterprise. On today's show, we are going to continue discussing vehicles of change. Specifically, we're going to be talking about equity crowdfunding as a vehicle of change. So, I want to start this conversation off by mentioning a very successful, perhaps one of the most successful investors of all time. That is Peter Thiel. He made his money as a co founder of PayPal. And with that money, he has been an active investor. One of his most famous investments and profitable investments was in Facebook in 2004. At that time, he invested $500,000 for around a 10% ownership stake in the company. Well, Facebook went public in 2012, and Peter Thiel made $1 billion, sold his shares for $1 billion. He bought them for 500,000 and he sold them for $1 billion. Now he still owns some shares, 100, $200 million worth of Facebook shares that he hasn't sold. He still has them. But he made $1 billion. That's a 2,000% return on investment in 8 years. He made 2,000% return on his investment in 8 years. Now, you or I, we can't make those investments. Well, none of us could in 2004. You had to be something called a accredited investor. That means you either have to have $1 million cash in the bank, or, and this is as of today, or $200,000 a year. You make $200,000 a year for the last 2 years as a single person, or you made $300,000 a year for the last 2 years as a married couple. I'm not sure of the requirements back in 2004, but they've been adjusted for inflation. So it's probably less, but if you compare value, it's about the same. So you had to be wealthy, and institutions could make these investments, and wealthy accredited investors. And you didn't just have to be uh, have the money. You also had to have the connections, the opportunity to invest in one of these companies. So the public has no shot at all in investing in Facebook in 2004. And let's say you are a successful surgeon and you qualify as an accredited investor. Well, you're not going to have the opportunity either. You have to have a connect. If you're a surgeon in Columbus, Ohio, there is really no shot for you to be able to invest in Facebook back in 2004. So even professionals that can qualify as an accredited investor still are generally locked out from these opportunities. Um, this is the private market of investments. Well, everything changed in 2012 when the Jobs Act was passed. Um, this allowed the general public access to the private market via crowdfunding. Now, it didn't go into effect until 2015. And really, it's only in the last couple of years, 2 or 3 years, where there are credible um, reliable, consistent platforms that facilitate equity crowdfunding. And there has been some more um, deregulation to allow uh, the general public as much access as possible, given the regulations that are still in place. But this is a huge step forward. Um, Now, imagine if you in 2004 invested, $100 into Facebook. You know, you're talking about a $200,000. And that's what a lot of these minimum investment requirements on these established platforms are, is $100. If you were given the opportunity Peter Thiel had, and you know, we're talking thousands and thousands and thousands of investors that if only they put in $100 and were able to cash out with $200,000 in 8 years, that's life changing for many many people, um, especially if you're making $30,000 a year. Life changing. So this system of a private market, and you have to be wealthy to even get in the private market. It obviously favors the rich. This is one of the main reasons why the rich are getting richer, because of the private market of investments. Like this is the ground floor of capitalism. The private market. If you can get into the private market, then in the past, especially, then you could, and you make one of these investments in a startup company. Now you can dictate the direction of these startup companies, or at least you have a loud voice, and you could really shape it, especially if the startup perhaps is struggling, is cash strapped. As a private market investor, you could say, well, I'll invest in your company, another $20,000, $50,000, but only if you do X, Y, and Z, and the company becomes more profitable. And this is how these startup companies suffer from mission drift. Maybe they have a different mission, but now they're in dire need of this capital, and so they're willing to sacrifice um, their mission, at least part of their mission, in order to stay solvent, to remain in the black, and to operate as a company. Crowdfunding has Equity crowdfunding has fundamentally changed this situation, because your average crowdfunder is, we're only going to be investing a few $100. That there is no, and there's so many of us, there isn't a voice in the founder's ear saying, okay, I'm only going to give you this money if you do this. Well, that no longer exists. The other thing is, uh, investors have a choice to fund companies that actually not only provide a valuable product or service, but does it in a way that uh, respects all stakeholders. That companies that have a responsibility to all stakeholders, and not just the shareholders. Shareholders are a stakeholder. Investors are a stakeholder, but so are the employees, the customers, vendors, suppliers, the communities, the companies in the environment, all stakeholders. So now, the general public can has the opportunity to invest in these companies that have a responsibility to all stakeholders. Well, why does that matter? Well, first off, Let's go back to Facebook. when they went public in 2012, uh, who did he sell his shares to? Well, he sold it to the general public, you and me. That they in the past, the rich were literally getting richer off of the general public, off these IPOs. Um, and so there is a push for maximizing shareholder value once you purchase an IPO, because you missed out on the big profits, and so now you want to make as much profit as possible as a shareholder, and you want these companies to maximize your profit for shareholder. Well, this causes a number of problems. um, Facebook, they have privacy concerns. They handle users' data. It's it they had the way they sold advertising. They really gave advertisers just massive access to user data. um, Facebook, because of their advertising and selling their ads, they created a environment for misinformation. Just deliberate. Now, not just, it's disinformation. I want to just say misinformation, but disinformation, which is different. That's intentional. Disinformation is intentionally giving false information. Misinformation is not intentional, and that's a slippery slope when you label something misinformation or not. But disinformation, um, Facebook, totally guilty of creating this environment for doing that. What else? Addiction. Um, Lots of research has gone into this now on the addictive nature of social media, and how difficult to disconnect from it. And this addiction leads to negative mental health. So you're having these consequences of mental health problems as a result of this addiction. Some of this is depression and anxiety. I know there was research done on teenage girls and the eating disorders that come about from this. Um, when you're on social media, you want to project this perfect image to others, and that you're lying to others. You're inauthentic, which can also cause depression. You're also comparing your life with other people, which you don't really know what they're projecting is even true, and yet you're comparing your life with them. So the mental health problems that Facebook has caused, and the polarization. So the algorithms that Facebook uses are to keep you online for as much as possible. That's how they maximize their profit. Through advertising and so this polarization and division will happen as a result of it, because the way to keep you online as long as possible is this confirmation bias feedback loop. Especially when it comes to things that are outrageous, that make you feel outraged. You feel outraged. You see, um, you have this belief. It's confirmed with this video or post that you see, and then you end up seeing more posts like it, and it doesn't give you a clear the whole picture. It's just a very narrow picture of what's happening. And it just compounds and keeps on going. And um, you know, I would think January 6th is a good example of this negative feedback loop, this confirmation bias feedback loop. I would say, the woke culture. I know that's kind of a overused expression, but that is also from this confirmation bias loop. Now, I gotta say, the woke and the January 6th, that I feel like people on both of those sides actually had real intentions. The January 6th people actually believed that um, the election was being stolen, and they wanted to stand up and do something about it. Of course, that it's shown that that's not the case, but nonetheless, that was perpetuated by social media, um, and also, this woke, um, I don't know, movement, I guess you could say, is really based on treating others with compassion and kindness and respect, but they're doing it by shaming and judging and really almost counterproductive way, deplatforming. Um, and the social media will just feed this. So here you are, you're having all these negative consequences to maximize profits for their shareholders. Now, you take that back and you have equity crowdfunding. Well, there isn't this push anymore to maximize profits because the general public has access to the big profits in the first place. Um, Companies don't always exit through an IPO, which stands for initial public offering. Sometimes these larger companies buy up these startup companies, and so that's how you end up making your money. Sometimes it is through a public offering. Either way, there isn't that push for maximizing profits because the direction of the company has already been established during this private stage, during the stage where they're growing. um, Not only that, the barriers to starting businesses for blacks and minorities has been um, historically horrible. It's incredibly difficult in the past to get private investors to invest in your startup company. Um, Today, the latest information, I still don't have the 2022 numbers, um, or maybe this was 2021, but we're talking 2.2% of all venture capital funding went to women founders, and 1.8% of all venture capital went towards African American founders. So these barriers to even get funding for your business if you're a woman or minority are essentially washed away with equity crowdfunding, because the general public, well, we're filled with minorities and women, and we now have access to invest in these companies that really have a different perspective on the way they see the world. And we need that. We need more perspective, um, and the equity crowdfunding is this incredible vehicle of change to provide that, to have companies in this world that are doing good, to be able to make big money as a just a regular person. Imagine getting a 2,000% return as a regular person. Nuts. It's crazy. But now it gives us an opportunity, the general public, an opportunity to get rich with the rich, and not the rich getting richer and everyone else staying the same. Now everyone has an opportunity to get richer. Um, and it's just an amazing time that we live in, that we can be a part of this. And I just love talking about it. I love to uh, mention equity crowdfunding, and hopefully it inspires you to become a crowd investor. Or if you're listening to this, you probably are a crowd investor. And I want to encourage you to continue doing it. Now, equity crowdfunding is risky. Most startups fail. And so that's when it's here. I'm going to do a shameless plug, but this is what this is why having an investment advisory firm that specializes in crowd investing could come in so handy, because we do have plans to mitigate risk when it comes to equity crowdfunding. It's probably the riskiest, one of the riskiest, not the most, but it's very risky uh, to invest in startups. But venture capital firms for the last 30 years have developed strategies to mitigate risk and get annual returns of 20-25%. And that's what I'm doing. I'm just seeing what all the top venture capital firms are doing it, and now I'm providing this service to the general public, so we can all get a piece of this action. And so that's I'll wrap up my talk here on equity crowdfunding for the day. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you'd like to know how to reform our unjust financial system legally, ethically, and without confrontation, go to Stakeholder Enterprise.